Good day, everybody, and welcome to the Ben and Boz Narrated PowerPoint series. I'm Boz.
I'm Ben.
Today, we are going to talk to you about stockholders' equity. Are you ready?
You don't care about how I'm doing today?
How are you doing?
I'm doing well today.
I just wanted to get into it. I'm excited, man.
Hey, it's a great day to talk about stockholders' equity, but...
It is. And we're going to use an example today.
I love it. Let's do it.
Of Kroger. You ever been to a Kroger?
No, but aren't they mostly grocery store chain in the south?
Yeah,
east,
I'm thinking south and east. We don't have them here in Minnesota. They're headquartered out of Cincinnati is where they're headquartered.
It's a good trivia track. Let's look at their equity.
All right. Well, in their stockholder equity section here, they've got preferred shares that are authorized, but they don't have any outstanding. We're going to talk about preferred shares in a little bit. Common stock, and this is in millions, so this is like 1.9 billion of common stock, and then additional paid-in capital, 3.1 billion. So they've issued, to kind of sum up those two amounts, about 5 billion of stock out to common shareholders. We're not going to talk about accumulated other comprehensive loss. That's a more advanced topic. Accumulated earnings, what does that sound like to you, Ben?
Retained earnings.
Good job.
A lot of companies just have a slightly different name, but all it means is retained earnings.
That can be frustrating to people learning accounting, but frankly, it's kind of fun when you get more advanced to have different ways of saying the same thing.
Does it make you sound smart?
Yeah, I don't know. I find it fun. So, common shares and treasury, a big thing. You can see $14+ billion. Those are shares we've repurchased. So we're going to talk about those a little bit, and that gets us to their total shareholders' equity of $6.9 billion, and we're going to ignore this concept of non-controlling interest.
Cool. So we should be pretty focused then. It should be good.
We should. So, this sheet's a little tough to see, but it's a snapshot of Kroger. It kind of goes through their changes. This is their statement of stockholders' equity. So common stock didn't change a whole lot. The 1.9 billion. Additional paid-in capital did not, again, change a whole lot. We're going to talk about they issued some shares, some share-based compensation. Treasury stock, they did some big repurchases during the year, so there was a change in that one. We're not going to talk about accumulated other comprehensive income. Accumulated earnings, how does that normally change, Ben? What are the normal two changes for accumulated earnings?
Hopefully accumulated earnings will go up over time, increasing with net income, but you will see some decreases with dividends, which is exactly what we see here.
1.9 billion of income, 400 million of dividends.
So roughly 25%
Solid
of their income they paid out in dividends this year.
Yeah. And the non-controlling interest, we're not going to get into that one. But that's just a little bit more details of this $6.9 billion of stockholders' equity.
Yeah, so you'll see on a lot of these equity pieces on the balance sheet, it doesn't give a lot of details. Pretty high level, not necessarily a ton of huge swings in those accounts. But then by looking here, you get more of a detailed vision. This is a statement of changes in stockholders' equity, which you actually did one of those. We talked about some of these earlier when we first started with our PowerPoint lessons. So This is more of a real one, a lot of movements that you see happening within.
Sure. So looking at Yahoo Finance, that's one of kind of a financial source we can find information from companies. And here Kroger, this is the key statistics side, and just a couple pieces that I wanted to pull out on here are the market cap, so $23 billion. And that compares to the previous slide, which had about $6.9 billion of stockholders' equity. Any thoughts? If someone said, "Why aren't they the same?" Ben, would you have a thought on that? I can jump in.
Yeah, I do have a few thoughts on that actually. So, to figure out our market cap, that reflects the current price of the company's equity, current value out on the market. Where what we saw on the previous slide, that was the book price. So what they initially issued that equity for. So that initial amount, would you say was 6.9 billion?
I think it was 6.9 billion. Yep.
That's what the company would have received initially in equity. And then that's out on the open market, like a grocery store, if you will, boss. You get it for stock. And since the time they've issued it, it's appreciated quite a bit, and now it's worth $23.68 billion.
Yep. Off-balance sheet intangibles is what we would say. So
that is the fancy way of saying it.
That's sure. Right. And then the other things from the key statistics is that they do have shares outstanding of about 800, pretty close to 800 million shares outstanding. On any given day, somewhere in that 6 to 9 million shares trade hands. The people exchange them. So active stock.
It's above what I can afford, boss.
It is, totally.
It's a lot of transactions, though. These are very active most of the times.
Yeah, totally. So what we're going to try to cover today, we're going to understand the purpose of share issuances, dividends, splits, and buybacks, and then how to account for common share issuances and dividends, understand how to account for preferred share issuances and dividends, then understand how to account for stock splits and stock repurchases. Is there any one of those you're most excited for today, Ben?
I do like common share issuances and dividends, especially a common share issuance. Just kind of gets people fired up a little bit.
That's true.
But they're all pretty awesome, to be honest with you.
Okay. They're all awesome. So we like everything accounting. So, issuing equity versus debt, advantages of issuing equity from a company's perspective, it's generally less risky and it'll keep cash flows higher because you don't have to pay dividends. Whereas with debt, you do have to pay interest or principal, or you would go bankrupt. People would eventually sue you for those.
Yeah, and you'd lose your assets, anything like that.
Totally. You can attract more investors than if you just issued debt. So,
and what do you mean by this one? Because in our last lesson, we talked about if a company issues public debt, it's not just going from a bank, right? It's going from individual investors as well. Yeah. So what do you mean by equity can attract more investors?
Because I did create these slides. I was like, what do you mean, Boz? What I was getting at with that, there's some people that just want debt, but there's some that just want equity. They want the opportunity to participate in the upside of a company. So you'll attract a different sort of investor if you issue equity. I think in general, companies that have a mix of both debt and equity are oftentimes the most effective, right? Because they can attract all sorts of investors, and the more investors you have, you can keep your costs down.
I wish we could look at a slide that compares debt versus equity from an investor's perspective.
Just hang on just a second.
We do have one? No way.
That's right. But disadvantages of a company issuing equity, you have to give up control. You have to give up some vote. Share issuances can actually be fairly costly. And then equity investors, they're going to want higher returns than lenders. In general, I think equity investors are going to want 10+% returns in stocks, whereas lenders oftentimes in today's market are more 4 or 5% returns. So you said you wanted to look at this, and then also you have to give up some of your residual profits. So since you wanted to look at this from an investor's perspective, why don't you talk about it?
That's a great idea. Bring it on. Let's do it. So if I'm an investor looking at, do I want to loan my money to a company through debt, or do I want to purchase a share of ownership in the company through equity? I'm going to consider my advantages and disadvantages. Biggest advantage, I have the ability to vote and potentially pick new management. So you actually see these, they're called proxy fights, where certain investors feel the company should be led in a different direction, and they'll nominate their own board of directors to lead the company, and if you like that, you can vote for it. So you actually get a say in how the company is run, which can be pretty cool.
So maybe if you asked me to invest in your honeybee business, I'd do it with equity so I could vote you out.
Okay, I'll give you 1% equity for $10 million.
We're going to get to that point as well.
We will get there. All right. Another big benefit here, if you own equity, you get to participate, get some of those dividends, residual earnings. Basically, you get higher returns traditionally than debt would give you. Okay. And of course, there's going to be exceptions, but in general, equity, you get a higher return than you do with debt because you are taking on more risk. So one of the big disadvantages, just because you buy a company that has given dividends in the past does not mean they're legally required to give you dividends in the future. So there is no requirement. You might not get any cash flow, and in fact, you could lose all of your money, which is the second bullet point here. If the company goes bankrupt, as a shareholder, you are at the very bottom of the totem pole. You're not going to get anything realistically. First, they pay off the debt, then whatever's left goes to equity, and usually that's nothing. And then final one, if you're just at an individual investor size, odds are you won't be able to own enough of the company to really influence that vote. So you get a vote, but if someone like CEO, CFO, they own thousands and thousands of shares, or institutions own millions of shares, your voice will kind of get drowned out by some of the big dogs.
So if I only own 1% of the honeybee business and you and your wife own 99%, basically I'm at the mercy of your decisions.
But if my wife and I each own 49.5%, you could be that tie-breaking vote.
I'm going to vote for your wife, totally.
Every time. That is fair.
So definitions when we talk about shares today. We have authorized shares. That's the number of shares that the company may legally issue. We have issued shares, which is the number of shares that the corporation has actually issued. We're going to talk a lot about treasury shares today. Those are shares that the company has repurchased. That probably sounds confusing, but we're going to talk about why they do that. And then issued less treasury shares equals outstanding shares. And the definition for that is the number of shares that the company has issued that remain available on the market, shares that are not yet repurchased.
So what do you mean by number of shares the corporation may legally issue for authorized shares? Because can a corporation just, fine, we're running it, we're going to issue the shares?
I think when the corporation is formed, there's legal documents that they have to fill out, and they have to. One of the things that they have to say is how many shares can we legally issue, and it's in the company charter. So it'd be, done on kind of the first day that the company's put into existence. The board would have to approve it, and then if they issue as many shares as they're legally able to do, I think the board would have to probably amend the charter at that point in time.
They do actually. It does happen sometimes, especially after stock splits and things like that. So
totally. So. Common stock issuances. Well, Ben, you said that you were excited about these, so you want to take this one?
Yeah, common stock issuances are cool because it's really the general public's first time they get a chance to buy into a company. A lot of companies, like Trinka Honey, LLC, you might say, are privately owned. And even if Boz is really excited about Trinka Honey, he can't just go and buy an ownership share because we're not selling it. But once a company goes public, they have what's called an IPO, and that's the first time they're releasing whatever number of shares available for public ownership. So usually you hear a lot about big ones in here. We're going to talk about Twitter in a little bit. Facebook has had one. I guess that was 5 years ago now. Spotify just had one a little bit recently. There's a ton of these.
Recent,
yeah, yep. Snapchat as well. So this is a big deal for everyone. But sometimes the company says, okay, we raised a bunch of money in that initial public offering right away, but now we need to issue shares again because we want to raise some more capital. Maybe we're expanding or we're doing something, right, that requires a lot of cash. So that's when they can have what's called a seasoned offering or a secondary offering, sometimes it's called as well. And I guess the third key part here, a lot of people tend to struggle with this idea, but after a share is issued by the company, that company does not necessarily get additional money for it. So instead it's traded in an established market, like the New York Stock Exchange would be a market that people could go to buy and sell shares. And any sort of difference in the share price, that impacts the individual investor who has it. So you can see in the example, company raises $1,000 by issuing 100 shares at $10 a piece. So the company gets $1,000. That's it. Then they're done, right? They don't own the shares anymore. So when the price jumps up to $50 a share, then that $40 gain from the $50 from the $10 up to the $50, the company doesn't get an extra $40 per share. Whatever investor owned that share of stock at the time of the gain, they get that $40 per share. So there's a lot of potential for improvement, which is what excites me about equity.
Yeah, and it's you look at that, and so if that example happened, and like if that stock price went up to $50 on the first day, we would say that company left a ton of money on the table, and they should have issued those shares at $50 because now those are individual investors who get that money and not the company. Now the risk is you could have said, well, if they just tried to issue these shares for $50 and no one wanted them because they thought they were too expensive, well, then you've spent a lot of time, a lot of effort, a lot of money paying bankers and stuff like that to go through this, and now you didn't come up with any money, and the company looks negative. So I think they usually hope that the share price gets a nice little bump afterwards.
Make those initial investors a little bit happy.
But yep.
It's a really complicated thing.
Yeah.
It's a really big deal and something that you could probably talk about in some of your other accounting classes.
Totally. So when a company issues the shares, the journal entry, you're going to debit the cash, which is the amount of cash the company got less fees. And oftentimes the bankers, you might get a % or something like that of the total cash raised, which can be very large. Credit common stock and credit additional paid-in capital. Par value, you see that term right there. It's the amount that's legally stated in the company's charter, and it basically is that shares can't be issued for less than that amount. It's usually really, really small.
Yeah, It used to be the idea of par value. It used to be, a way for a protection for investors, and that the company had to take that par value and kind of set it aside. And in case they did go bankrupt, equity would have the first dibs on that par value. But that was a long time ago, and now there's other protections out there for shareholders. So as it says in the last bullet point, though, most companies have it be really, really small. We're talking fractions of a penny. Or a lot of states don't even require you to have par value at all.
Sure. We thought, Kroger actually had like $1.9 billion of common stock and 3.1 of additional paid-in capital. That was probably a pretty old offering. When you see these today, we're going to go through a Twitter example. The par value is almost nothing. So from Twitter's, this is a few years old, but Twitter's a pretty popular one, so wanted to pull it out. They sold about 80 million shares of their common stock at an offering price of $26 a share. So then they got an aggregate price in that situation of $2 billion. Why does Twitter need $2 billion? What was really the purpose of that? Any thoughts on that?
A lot of time, not sure if it applies to Twitter, but a lot of times it's the owners, the people who created Twitter in the first place. They've created something that's worth $2 billion, and they want to cash out. They want to say, okay, maybe we don't necessarily need the capital right now, but I'm going to sell my shares that I have. And then everyone else can get to own a piece of Twitter.
Yep, exactly. So sometimes these are just new shares and the old owners don't sell out. Sometimes the owners do sell out as part of this. Sometimes it's a combination of both. And it says, what is the journal entry assuming basically a 1 cent per share par value? The actual documents, it's like not even a fraction. It's just a tiny fraction of a cent. But so we would then debit cash for the $2 billion that they received. We'd credit common stock for a penny a share for the 80 million shares, and then the difference goes to additional paid-in capital. So common stock dividends, you said you like those as well.
I do like those because as a common shareholder, this is when I get paid. I like to get paid. That's good. So why does a company pay a dividend? Well, number one, they provide that return to shareholder, keeps the shareholders happy, and everyone is, I guess, happy that way, right? There's not going to be a whole new change in management or board of directors if everybody's happy with it. A lot of times companies say it's the best use of cash that they have, where say a company that has matured, they're pretty well established, they might be about out of really good projects, opening up new stores or something like that for Kroger, and they'll say, okay, we have this extra cash just sitting on our books, why should we keep it? Let's just give it back to the owners instead. It increases investor confidence. When you have that long history of dividends, like Abbott Labs is an example, they have consistently increased their dividend every year for 46 straight years. That's pretty impressive, and they're not alone. There's other companies too. So it actually helps build up some more faith in the company to investors. However, GE, they've been going through some troubles recently. In November, they announced that they were cutting their dividend. It was only like the second or third time they had done that in a century. Like, it's very rare that they did that. And immediately their share price dropped 8%. People were a little bit concerned about it.
They did it back in the recession 10 years ago, but then people kind of understood because, everyone was getting clobbered in the recession. But right now the economy's pretty good, so the fact that GE's cutting their dividend is not a good sign.
Yeah, exactly. So you do see that a lot. Usually, probably 99.99% of the time, dividends are going to be paid out in cash. There are things like property dividends or stock dividends, like a 10% stock dividend or 80%. We're not going to get into that here because those aren't really very common.
You see those more with small businesses, and really the focus of this course is the big corporations, and they pay out the dividends in cash.
Yeah, exactly. So in general, dividends are going to reduce the value of the company. Think of it, that company had the cash with them, and now they don't have it anymore, right? But it's not necessarily a bad thing because it's not like they're just throwing the cash away. They're giving it to the owners and returning it to them.
Yeah, so let's the accounting for this one. Let's look at 3M. They're a company here in the Minneapolis area that they, on November 13th, they issued a press release that said the 3M Board of Directors today declared a dividend on the company's common stock of $1.36 per share for the fourth quarter of 2018. The dividend is payable on December 12th, 2018 to shareholders of record at the close of business on November 23rd, 2018. A lot of dates on there. So
a lot of dates, definitely.
Go through and talk about what they mean. So on the September 30th, 2018 financials, 3M had about 582 million shares outstanding. So they're going to pay the $1.36 dividend on each of those shares. So the date of declaration. So on the date of this press release, at that point in time is when they have a liability. All right. So they have a dividend payable liability because they have said they're going to pay the dividend on that day. So they're going to debit retained earnings and credit dividends payable on that day. How about this second date on this one?
And just briefly, to get that a number, 791.93 million, we took the number of shares outstanding, 582.3 million, multiplied by the $1.36 per share. So that's the amount that they're going to have to pay. And then so your actual question, on the date of record, November 23rd, this is where the company says at some point they got to, close it. They got to say, okay, we need to know who has all the shares as of November 23rd, 2018, and anyone who had the shares, then we can work with our trustee. They'll figure that out, and they'll arrange the right payment so that it actually comes through on December 12th. What is actually used in the industry is what's called an ex-dividend date, and that is really a couple days before the date of record, because transactions in the market, some of them do go through pretty quickly, but other times it takes a little bit to transfer the cash, make sure everything works out, and really finalize all the deals of the transaction. So really companies look at the ex-dividend date, which in this case would probably be like November 21st or a couple days beforehand, make sure all the transactions have cleared, then they have the date of record, November 23rd, they can use all the owners then.
Sure. Why this is important is because there's millions of shares changing hands every day for 3M. So it's not like Ben's honeybee business. He and his wife want to take a dividend, boom, they just take it. They're the only owners. It's easy. 3M, you got millions of shares changing hands. You got to somehow get that money to the people who it belongs to. And then when you actually do make that payment, at that point in time, you get rid of your liability on December 12th. So you debit that payable account, and then you credit your cash.
We're set.
We are. We got the cash.
Do you prefer common stock?
I suppose I would prefer common stock, because
Okay.
it's probably the highest risk, highest reward. But some people might want something that's a little safer called preferred.
Oh, no
stock.
way! What are the odds?
I think they're pretty high because you set me up there. But preferred stock, it has a fixed return and it does not have voting rights. So it's probably more similar to debt, I would say, than common equity. In the event of a bankruptcy, debt is paid first, then preferred stock, and then the leftovers go to common stockholders. So I look at this as riskier than debt. So it gives you higher returns than debt, but not as risky as common stock. So your returns are not quite as high then. An example on this one, so GE, they issued 5.7 billion shares of preferred stock, $1 par value, and a dividend rate of 5%. So now we want to talk about what is the journal entry for issuing that preferred stock.
And even before we get there, I just want to jump in a little bit. Preferred stock, it's like a hybrid between debt and equity, and it's not necessarily defined the same way for every company as far as the benefits. And we're going to get into that a little bit. Sometimes preferred stock has voting rights associated with it. Sometimes it doesn't. When it does have voting rights, it's more similar to equity. When it doesn't, it's more similar to debt. And also with that payment of the dividend, right? Is it guaranteed? Is it not? We're going to get into that a little bit. But it's really just a hybrid between the two.
I think that most established companies probably don't issue new preferred stock. This is a big thing with startups. They're trying to attract investors who maybe want an alternative form of investment.
A little bit more on the assurance side that they're going to receive something in return.
So. Yeah. So if GE does this, they issue the preferred stock, just a debit to cash for the $5.7 billion, credit to preferred stock for $5.7 billion. And that is a stockholder's equity account. That's where it'll show up on the balance sheet.
Yeah, and you could have preferred stock, par value, and additional paid in capital, things like that. But for the most part,
I usually see it par value.
Yeah, it's pretty much always just issued at par value. So.
Yeah. So now let's talk about what happens when you actually make dividend payments on that preferred stock. So again, GE issued 5.7 billion shares, 5% annual rate, but they pay dividends twice a year. So we take 5.7 billion times 5% and then divided by 2 for that twice a year payment that they debit retained earnings for.
I'm really glad you did all that math for me.
I like that math.
When we get into the billions, it gets a little complicated.
That's right. So debit retained earnings and credit cash for that $142.5 million.
That's pretty much exactly like a common stock dividend, isn't it?
Yeah, the same entry. So it's just got to go through those computations to get there. So cumulative versus non-cumulative preferred stock dividends. Cumulative means that If you don't pay preferred dividends in a year because maybe the company doesn't have cash, they do have to pay those before they can pay any dividends to common shareholders. And this is referred to as dividends in arrears.
Seems nice.
It is.
If I'm an investor, I would like that.
Yep.
Fine, you missed 1 year, but you're not paying anyone else till I get paid.
Exactly.
I like that priority. That's
Yep.
good for me.
The alternative would be non-cumulative, which means that if preferred dividends do not get paid in a year, those are effectively lost. We're going to show an example of what that means, and we certainly don't like to lose things. So, Ben, if you had a choice, what kind of preferred stock would you like, cumulative or non-cumulative?
Cumulative, for sure.
Cumulative,
no
for
doubt,
sure.
yeah.
And here, the example on this one, a company wishes to pay $1,000 of dividends in 2018. Dividends to preferred shareholders are $100 a year, but were not paid in 2016 or 2017. What amount of dividends will be paid to preferred versus common shareholders if we have both cumulative and non-cumulative? Not both. We're looking at two different scenarios.
Yeah, it'd be
here.
one or the other, but it's helpful to see the side-by-side comparison, so you get a sense of what you would get if you were an investor.
Yeah. So again, in 2016, if it's cumulative preferred stock, they get the $100. And again, this is a 2018 payment, but it's related to 2016 dividends. In 2017, we also had dividends in arrears of $100, so we have to make that payment.
But non-cumulative doesn't get anything.
They don't get
huh?
anything in either of those 2 years.
You missed it, too bad.
Yep.
Move on. Mm-hmm.
2018, then the non-cumulative, if that's what the preferred stock was, they would get it then.
Because it is 2018 right now, so they get that.
2018 dividend. So the total dividend to preferred shareholders is $300 if it's cumulative, only $100 if it's non-cumulative. The common shareholders get the difference, and that example right there is why preferred stock shareholders would normally prefer cumulative preferred stock.
Yeah, it could really push down the value of the preferred stock if it was non-cumulative. That's a lot of risk that a preferred shareholder would take without necessarily having a lot of returns. So
yeah, if you try to sell me preferred stock on Trinket it's not going to be non-cumulative. That's all I'm saying.
Okay, I'll make it cumulative.
Just give a very low rate.
We'll just be very low rate. Yeah, not even 1%.
That's right. You want to take stock splits here?
Yeah, sure. So stock splits are when a company's stock price gets really high, and we're going to go through some examples in a future slide here, but we're talking into the thousands of dollars per share, and it makes it kind of hard for an individual investor like a one person just to buy any number of shares in that because it costs so much. So what companies would do is split their stock, and that in turn would then drop the price. Say if you did a 2-for-1 split, that's the most common one, but you're going to split the stock so there's twice as many shares outstanding, but each share is cut, the price of each share is cut in half. So if it was $100 per share, then it's going to drop down to $50 per share, but now you'll have 2 shares worth $50.
Makes it more attractive to investors.
Yeah, it's more in that target price range that they go to. So as an example here, recently at the beginning of 2018, Aflac did a 2-for-1.
They have a duck.
Wait, who did a 2-for-1 stock split?
Aflac. It's a duck. They're an insurance company.
Is it a duck?
I don't know. Hopefully people have seen the commercials. If they haven't,
I hope they did.
Aflac.
It's kind of funnier this way. But yes, they have catchy commercials that obviously work because they use a duck. But before the split, they had 390 million shares outstanding. Each had a price of $90 per share, and they said, that's a little bit high. We want it to be lower. Maybe we'll generate some more interest. Nothing is really changing about the company. Operations aren't changing. They just, in the market, they want to have a lower price per share to make it more attractive. And so we are going to double the shares outstanding and then divide the stock price by 2. And that'll give us 780 million shares outstanding with a price of $45 per share. Now, it makes me happy as an investor. It hasn't changed, but it feels like I have that much more.
Absolutely. So fewer companies are splitting their stock, though. So here's an example of the priciest stocks in the world in 2018. I only recognize a few of those. Alphabet, who is that? Not everyone knows this.
Yeah, that's Google.
That is
They
Google.
recently switched to Alphabet.
Yep, $1,000 a share. What that means is if you don't have $1,000, you cannot buy a share of Google. That's a limitation of not going through splits. Amazon, you recognize them, $1,500 a share.
They were even higher too. They've been getting beat up in the market recently.
Yep. So this is just if you want one share of these. We can go up and
my personal favorite,
the highest one, Berkshire Hathaway. That's Warren Buffett, $300,000 for a share.
I can't afford one share of that.
No, and what that is, well, that's the purpose. He wants to keep the ordinary, person out of that. There's a little prestige in that, but then it limits the type of people who can buy a share into very high net worth individuals.
And he also believes that you don't add any value with the stock split, so he's not going to waste his time doing it.
Yeah, they've got a different class of shares that's a lot cheaper, but those people can't participate in the vote, actually. So as an example, Apple is a company that has split its stock, and if they hadn't, they'd be worth nearly $10,000 per share instead of about $170 per share. So Apple, because they've chosen to split their stock, more the everyday person can get involved and have ownership in there. Just different strategies.
Cool.
So, but
let's look at it.
Splits. You want to do the accounting for it?
Let's do the accounting. I can handle.
Pretty complex.
I can handle this accounting. So, number one, no journal entries with stock splits. You're going to have to show a difference on your financial statements with what the par value is and the number of shares, but there's no actual journal entry to do that. So, with no journal entry, no impact on retained earnings. Remember, dividends, we were impacting retained earnings, but not on stock splits. And you just have to disclose it in a footnote and say, on this date, the company underwent a stock split. 2-for-1 is the most common. I've seen 3-for-2. We're going to go through an example that's not 2-for-1, but 2-for-1 is usually what it is. And then, so like we said before on the financial statements afterwards, you just have to show all the shares, earnings per share retroactively, so the change, to show that, okay, if the split happens in 2013, 2012 numbers, the comparison on your financial statements would be a little bit off if you didn't affect those as if the split had happened in previous ones. So to show that, we have an example to help take us through it.
So Apple went through a 7-for-1 split in June of 2014. And we've now got on the left-hand side, these are their financial statements. It's actually their second quarter, so their 10Q for the second quarter of 2013. That's what's on the left. It's the 10Q for the second quarter of 2014 on the right. A lot of numbers. We want to highlight just a couple here. Ben liked my Apple example that I found, but I liked Ben's animation. So we highlight earnings per share were $7.51.
Thank you for that shout out, Boz. I appreciate that.
Yep, but then they went through the 7-for-1 stock split, and what that means then is when they did that stock split in 2014 and they showed their quarterly financials, they are now showing the 2013 quarter as if the split happened so that it's comparable to the 2014 quarter.
Yeah, we just see that number. It was 751 when they first initially issued their 10Q on June 29, 2013.
Yep.
And then now after the split, that 751 has changed to 1.07, which, would you believe it? If you divide 751 by 7, that's really what you get.
I did the math. I did the math.
I did too. I just wanted to make sure, though.
Absolutely. Yeah. So, when they initially issued that 10Q in 2013, they had about 900,000 shares outstanding. And then because they did the split, then they showed it as if they had 6.4 million shares outstanding, multiplied by 7. And then dividends, they were truly $3.05 per share, but for comparability purposes, if we have 7 times as many shares, we have to cut that dividend or divide it by 7. And again, what we're trying to do is we're trying to compare it, because now we can see, Apple did increase their dividend by 3 cents a share, one year over the next. If we had just left, this $3.05 in this column right here, we might say, wow, Apple, their dividends went from 3.05 down to 47 cents. What's wrong? But it's like, well, no, they truly have paid out more cash dividends.
Yeah, same thing with earnings per share too. It's like, wow, it was 7.51 and now it's $1.29. That's not good.
Yep.
So
We got accounting information has to be comparable. So treasury stock and stock buybacks.
Yeah, let's do one last topic in this one here. So treasury stock, a lot of times a company is going to generate free cash flows. And so free cash flows are, they've made money from their operations. They just have extra cash, and they have some options as far as what they want to do with it. So, Boz, what are some things that a company could do with their free cash flows?
When I talk to company management, they're always thinking first on organic growth, all right? So they're always thinking about what can we do to grow our own business. But sometimes they tap that out, right? And if they tap it out, then you might look at acquiring another company. All right, so go ahead and do an acquisition to expand. If you can't grow organically, there's not another good company to acquire, then you might be like 3M, do a big dividend payment. All right. Now maybe you've got a nice stream of dividends going, but you still have some cash flows.
Or you want to hang on to that cash, right?
Yep. And then what you could do is you could just put it in the bank, right? Or
Yep,
invest it in treasury bonds or something, or
government
shares of
bonds.
other
Invest
companies.
in other companies and stuff, yeah.
And then, but those usually pay pretty low returns because companies don't want to be that aggressive. So then oftentimes what they will do is go to a stock buyback, which means that they are going to repurchase shares of their own company. So the company is using its cash to buy shares of its own company, just like an individual investor would. This can get pretty big. Apple, as an example, over the last 5 years, has repurchased $150 billion worth of shares.
Did you want to redo that?
Apple, in the last 5 years, has repurchased $150
Billion.
billion.
That was much better, much better.
We feel better.
But we do see this happening. Actually, there's been quite a few buybacks happening in the last decade or so, really. A lot of stock prices went down immediately after the recession, so prices were a little bit lower. And while those prices came up, the cost of debt was pretty cheap. So a lot of companies issued a lot of debt so that they could repurchase their shares.
Exactly. So this is, it's interesting. Companies do IPOs, they issue a bunch of shares and get cash, but then as they grow, they're like, well, maybe we don't need that many shares out there. So now let's talk about why a company would buy back stock. One reason that they would do it would be to make the remaining shares more valuable. We'll go through an example of that in a moment. What's another reason, Ben?
A lot of times a lot of companies are going to want to issue shares as parts of compensation to their employees. If I'm a top-level executive, I am more motivated when I see, my own shares in the company. I have more stake in the game. I want to make better decisions. And so to issue a brand new share is actually a little bit complicated for a company. There's a lot of legal costs associated with that. And so instead, it's a lot cheaper and a lot faster to just repurchase a share on the open market and have those ready to go to give to employees as they are earned.
Exactly. So an example here about how it can make it more valuable. If a company has $100 of operating assets, which give returns of 15%, and $1,000 of cash, which gives returns of 1%, and let's say they have 10 shares outstanding, their base case here is they're making $25 of income and therefore $2.50 of earnings per share. So that cash isn't giving them very nice returns. If they take that cash, and let's say they could buy back 5 of those shares for that cash, then their earnings per share calculation, they still have their operating income, no longer any interest income, but they still have the operating income, but it's spread over fewer shares. So that's an example of how they've actually increased their earnings per share by buying back shares that were outstanding.
Yeah, a lot of large companies that have kind of matured and where their markets aren't really growing that much anymore, they can drive EPS growth by doing these share buybacks.
Totally. So now accounting for treasury stock, when the shares are repurchased from the public, they're going to debit treasury stock, which is a decrease to shareholders' equity. We saw in the opening an example today with Kroger that's usually a very large negative number in the stockholder equity section, and then they credit cash. Now, they might want to resell it to the public at some point, or probably to your point, issue stock compensation would probably be the most common
Well, a lot of times that stock compensation could be options,
yeah,
where an employee has an option to buy stock at $10 per share, even though it's trading at $100 per share right now. And so then, in theory, that employee would be making $90, right? Buy it for 10, sell it for 100 right away.
Sure.
They make $90 right away. So when those treasury shares are sold back, our company is going to debit cash for whatever cash they receive. It could be market value, it could be something else. They're going to credit treasury stock. And if there is an extra price, so say they repurchased the stock at $8 per share before they issued those options, and then they're receiving $10 per share when someone's exercising the option, they get an additional paid in capital account for the extra $2 above and beyond what they paid for it.
Sounds good. Well, I think we're going to wrap it up now. A lot
Let's
of materials here today.
Equity has a lot of little parts to it, but it's all right. It all kind of fits together.
That's right. Not one big formula like some of these other lessons. But, companies, they're often going to issue equity instead of debt in order to attract a different sort of investor. The most popular form of equity is common stock, on which companies are not required to pay dividends.
Shareholders take on some risk. They hope there'll be dividends, but they also hope to get some stock appreciation.
Totally. Preferred stock, a lot with growing companies, newer companies. It's a hybrid between debt and equity, and therefore provides returns kind of between those two amounts. And then companies with excess cash, they can repurchase shares for two reasons: return cash to investors and increase earnings per share for the remaining investors. Any final word of wisdom you have, Ben?
Equity's pretty cool.
Equity's
Invest young. That's my word of wisdom.
That's right. Yep. Invest young so you can enjoy that appreciation. Well, thanks everybody for tuning in. We'll be back for another lesson on the statement of cash flows.
Woohoo! Lesson 11. Can't wait. Bye, everybody.
See ya.